Hello, I'm Paul Jennings. Welcome to this video on the Conceptual Framework for Financial Reporting. I will talk about three key ideas in the Conceptual Framework. 1. What is the objective of financial reporting? 2. How do we decide what makes information good quality? And 3. The elements of financial reporting, the categories that we use to formalise and standardise our reporting of business performance. In this video, I'll talk about the second of those three key ideas, the criteria that we use to identify what makes information good quality. The conceptual framework tries to define what high quality information is, or what makes information useful. These are the characteristics of useful information, known as qualitative characteristics in the language of financial reporting. Now, I think of these characteristics as cats and kittens, just because it helps me to imagine how the characteristics work. Primarily, useful information is relevant and faithfully represents the underlying economic phenomenon that it purports to represent. The words and the numbers on the screen or the page should communicate a realistic picture of the underlying economic reality. So we have two cats, and I've called them relevance and faithful representation. The two cats represent the primary qualitative characteristics of useful financial information. By relevance, we mean that information has predictive or confirmatory value. It can help users to predict future outcomes, for example future profits, or it can confirm or refute previous predictions. And by faithful representation, we mean a depiction which is complete, neutral, and free from error. Complete means that all the information that a user needs to understand the economic phenomena is included. Neutral means that the representation is unbiased, it's neither overly optimistic nor overly pessimistic. Free from error means that there are no errors in the depiction which would make a difference to the economic decision. In real life, information does not have to be completely accurate, but it has to be good enough for our decision-making purposes. Then there are four secondary qualitative characteristics, known as enhancing qualitative characteristics, which also contribute to high-quality information. And I think of these as kittens. Those kittens are called comparability, verifiability, understandability, and timeliness. Comparability, first. Good quality information allows users to compare the financial results of a business over time or with other businesses, alternative investments. Information is verifiable if independent observers are able to agree that the information provided is a faithful representation of the underlying economic reality. Information should be understandable to users with a reasonable level of knowledge and expertise, and it should also be timely. These secondary characteristics are kittens because they are enhancing rather than overriding. If there's a conflict between the primary characteristics and the secondary characteristics, then the primary characteristics prevail. For example, you cannot justify oversimplifying information to the extent that it's no longer a faithful representation just to make it more understandable, because faithful representation is a primary characteristic and understandability is a secondary characteristic. If the underlying economic phenomenon is complex and difficult to understand, then its representation will be complex. Now, one final point about quality. In any business decision, there is an overriding cost-quality trade-off, and this is formalised in the conceptual framework as the cost constraint. The costs of reporting better quality financial information need to be justified by the extra benefits of that better quality financial information. So there is a balance to be struck between maximising the qualitative characteristics of financial information and producing that information at an acceptable cost. And I think of the cost constraint as a big angry dog because, well, how else do you keep cats and kittens in line? So, firstly, we identified our overall objective: to provide high quality information about the financial position and financial performance of a business to actual and potential shareholders and lenders. And secondly, we defined what we mean by high quality information in terms of what are the characteristics of good information. In the next video, I'll talk about the third key idea, the elements of financial reporting.